Welcome to our comprehensive guide on the appointment and remuneration of managerial personnel under the Companies Act 2013. In this video, we'll break down the key provisions, eligibility criteria, and procedures for appointing top management in company, including managing directors, whole-time directors, managers, and key managerial personnel. We'll also cover how remuneration is determined, the limits imposed by law, and special cases like inadequate profits. End of this video, you'll be able to describe the legal provisions for appointing managing directors, whole-time directors, and managers. You'll also understand the concept and appointment process for key managerial personnel, calculate profits for managerial remuneration, and explain compensation for loss of office. Additionally, we'll discuss the functions of the company secretary and the requirements for secretarial audit. These outcomes will equip you with the knowledge to navigate money. Before diving into the appointment process, let's clarify some essential terms. The Chief Executive Officer, CEO, is the officer designated as such by the company. The Chief Financial Officer, CFO, is the person appointed to oversee financial matters. The company secretary is a professional appointed to ensure compliance with company law. Key managerial personnel, KMP, includes the CEO, Managing Director, Manager, Company Secretary, Whole-time Director, CFO, and SAT. Manager, as defined by Section 2(53) of the Companies Act, is an individual who manages the whole or substantially the whole affairs of a company under the supervision of the Board of Directors. This role is distinct from departmental managers, as only those with authority over the company's overall operations qualify. The manager may or may not be a director, but cannot be appointed if a managing director is already in place to avoid overlapping authority and potential mismanagement. Managing director is a director entrusted with substantial powers of management, either by the company's articles, an agreement, or a board or general meeting resolution. These powers exclude routine administrative acts, such as signing checks or share certificates. The managing director must be a director, regardless of the title used, and their authority is always subject to the board's control. Importantly, a company cannot appoint both a managing director and a manager simultaneously. Whole-time director, WTD, is a director who is in full-time employment with the company. This means they devote their entire working time to managing the company's affairs. Only a director can be appointed as a WTD, and they must be fully committed to the company's operations. The distinction ensures that the company's leadership is dedicated and accountable for day-to-day management. Remuneration, as per Section 2(78), includes any money or its equivalent given to a person for services rendered, along with perquisites defined under the Income Tax Act. This broad definition covers salaries, bonuses, commissions, and benefits, ensuring that all forms of compensation are regulated under the Companies Act. Section 196 lays out the rules for appointing managing directors, whole-time directors, and managers. A company can appoint either a managing director or a manager, but not both at the same time. However, it can have both a managing director and a whole-time director. The tenure for these appointments cannot exceed 5 years at a time, and reappointments cannot be made earlier than 1 year before the current term expires. To be eligible for appointment as a managing director, whole-time director, or manager, a person must not be disqualified under Section 164. They must be at least 21 years old and not older than 70, unless a special resolution is passed for those above 70. Additional disqualifications include insolvency, suspension of payments to creditors, or conviction for certain offences. Schedule V also prescribes further eligibility conditions, such as not being detained. Appointment of a managing director, whole-time director, or manager must be approved by the Board of Directors at the meeting and then by shareholders at the next general meeting. If the appointment doesn't meet Schedule V conditions, central government approval is required. The notice for the meeting must disclose terms, remuneration, and any director's interest. A return must be filed with the registrar within days of appointment. For managing director, whole-time director, or manager acts before their appointment is approved at general meeting, those acts remain valid, provided they comply with the Companies Act. This ensures continuity in company operations even if the appointment is later not approved. Certain exemptions apply to government and private companies regarding appointment procedures. For government companies, some provisions of Section 196 do not apply if they have not defaulted in filing financial statements or annual returns. Similarly, private companies are exempt from specific requirements if they are compliant with filing obligations. These exemptions streamline the process for these types of companies. Consider an example. Sukanya Limited appoints Mr. Rajaram as managing director, giving him substantial management powers. Later, they want to appoint Mr. Rakesh as manager of the finance department. However, since Mr. Rakesh would only head a department and not the whole company, he does not meet the definition of manager under Section 2(53). Thus, the company can proceed with his appointment as a departmental manager without following the strict provisions for company-wide. Section 203 mandates that certain companies must appoint key managerial personnel, KMP, on a whole-time basis. This includes every listed company and every public company with a paid-up share capital of 10 crore rupees or more. Private companies with similar capital must appoint a whole-time company secretary. KMP roles include MD/CEO/manager, company secretary, CFO, and in their absence, a whole-time director. Individual cannot be appointed as both chairperson and managing director or CEO at the same time unless the company's articles allow it or the company does not carry on multiple businesses. However, for companies engaged in multiple businesses with separate CEO, this restriction does not apply. This ensures clear separation of powers at the top management level. Every whole-time key managerial personnel must be appointed by a board resolution specifying the terms and remuneration. This ensures transparency and collective decision-making at the highest level. The resolution must be passed at the board meeting and recorded in the company's official records. Whole-time key managerial personnel cannot hold office in more than one company at the same time, except in a subsidiary. However, they can be a director in other companies with board permission. If someone holds multiple KMP positions at the start of the act, they must choose one company within 6 months. Person can serve as managing director or manager in up to 2 companies, provided the appointment is approved by a board resolution with the consent of all directors present. Specific notice must be given to all directors, and the appointment must also be approved at a general meeting. This ensures proper governance and prevents conflicts of interest. If a whole-time KMP position becomes vacant, the board must fill the vacancy within 6 months. This ensures that key leadership roles are not left unfilled, maintaining stability and compliance in company operation. Failure to comply with KMP appointment rules can result in hefty penalties. The company may be fined up to lakh rupees and defaulting directors or KMP up to 50,000 rupees each, with additional daily penalties for continuing defaults. This underscores the importance of timely and proper appointment. Company secretary plays a vital role in ensuring compliance with the Companies Act and other laws. Their functions include reporting to the board, ensuring adherence to secretarial standards, guiding directors on their duty, facilitating meetings, obtaining approval, representing the company before regulators, and assisting in corporate governance. They are also responsible for maintaining minutes and records. Secretarial standards are issued by the Institute of Company Secretaries of India and approved by the central government. They cover meetings of the board and general meetings, ensuring uniformity and best practices in company administration. Adhering to these standards is a key responsibility of the company secretary. Section 200 allows companies to set administrative ceilings for managerial remuneration, especially when profits are inadequate. While no central government approval is needed for such cases after 2018, companies must consider financial position, remuneration in other capacity, professional qualification, and other prescribed factors when fixing pay. In determining managerial remuneration, companies must review financial and operating performance over the past 3 years, the relationship between pay and performance, proportionality among directors and employees, differences in pay policy, and securities held by directors. This ensures fairness and alignment with company goals. Section 197 sets the overall cap for managerial remuneration in public company. The total cannot exceed 11% of net profits, with specific sublimits for managing directors, whole-time directors, and managers. These limits can be exceeded only with shareholder approval via special resolution. Sitting fees are excluded from these percentages. If a company has no or inadequate profits, remuneration to directors and managers must comply with Schedule V. The limits depend on the company's effective capital, and higher pay requires a special resolution. This ensures that pay remains reasonable even in tough financial times. Effective capital is the sum of paid-up share capital, share premium, reserves excluding revaluation, and long-term loans minus investment, accumulated losses, and preliminary expenses. This figure determines the maximum permissible remuneration when profits are inadequate. In certain cases, such as newly incorporated companies, sick companies under revival, or those with approved resolution plans, higher remuneration may be paid for a limited period. The company must meet additional conditions, including creditor consent and certification by an auditor or company secretary. Certain perquisites, such as provident fund contribution, gratuity, and leave encashment, are not counted towards the remuneration ceiling. Expatriate managers may also receive allowances for children's education, holiday passages, and leave travel, which are excluded from the cap. Managerial person can draw remuneration from 2 companies, provided the total does not exceed the higher maximum limit allowed by any one of the companies. This provision is especially relevant for group companies and holding subsidiary structure. Remuneration for directors is determined by the company's articles, a resolution, or a special resolution if required. Payments for professional services are excluded from managerial remuneration if the director is qualified and the board or nomination committee approves. Directors may receive sitting fees for attending board or committee meeting, up to 8 lakh rupees per meeting. Independent and women directors must receive at least as much as other directors. These fees are separate from managerial remuneration cap. Remuneration can be paid as a monthly salary, a specified percentage of net profits, or a combination of both. This flexibility allows companies to structure pay packages that align with performance and company policy. If a director receives excess remuneration, they must refund it within 2 years or a shorter period allowed by the company. Until refunded, the amount is held in trust. Waiver of recovery is only possible with a special resolution and, in some cases, prior approval from creditors. Listed companies must disclose in their boards report the ratio of each director's remuneration to the median employee's pay, percentage increases, number of employees, and other details. This promotes transparency and accountability in executive compensation. If a company pays insurance premium to indemnify directors or KMP against liability, the premium is not treated as remuneration unless the person is found guilty of negligence or breach of duty. This protects directors from personal financial risk while acting in good faith. Managing or whole-time director can receive commission from both the company and its holding or subsidiary, provided this is disclosed in the board's report. This allows for fair compensation across group entities, subject to overall limits. Non-compliance with Section 197 can result in penalties of 8 lakh rupees for individuals and 5 lakh rupees for the company. The auditor must also report on whether remuneration complies with legal limits, adding another layer of oversight. If a company must restate its financial statements due to fraud or non-compliance, any excess remuneration paid the past or present MD, WTD, manager, or CEO must be recovered. This ensures accountability and protects shareholders' interests. Section 198 details how to calculate net profits for remuneration purposes. Certain items are added or excluded, such as government subsidy, capital profits, and specific deductions like working charges, directors' remuneration, and depreciation. This standardized calculation ensures consistency across companies. If a company wishes to appoint a managing director over 70 years old without passing a special resolution, it must apply to the central government within 90 days. The process includes notifying members and publishing notices in newspapers. This ensures transparency and regulatory oversight. Company may pay compensation to a managing director, whole-time director, or manager for loss of office, but only under specific conditions. The amount cannot exceed what they would have earned for the remainder of their term or 3 years, whichever is shorter. No compensation is allowed if the director is guilty of fraud, breach of trust, or gross negligence. Listed companies and certain large public companies must conduct a secretarial audit by practicing company secretary. The audit report is annexed to the board's report, and the company must provide all necessary assistance. Penalties apply for non-compliance, ensuring that larger companies maintain high standards of governance. Schedule V of the Companies Act details the limits and conditions for managerial remuneration, both when the company has profits and when it does not. It also covers special circumstances, perquisites, and exemptions. Understanding Schedule V is essential for compliance and effective remuneration planning. Sum up, the appointment and remuneration of managerial personnel are governed by detailed provisions in the Companies Act 2013. Companies must follow strict eligibility, appointment, and disclosure requirements and adhere to remuneration limits based on profits and effective capital. Secretarial audits and board disclosures further ensure transparency and good governance. By understanding and applying these rules, companies can ensure compliance, attract top talent,